So the Fed today raised interest rates by 75 basis points, and the market didn't take that very well. The Dow closed down roughly 500 points, the S&P down almost 100 points. As a matter of fact, let me just go ahead and switch over to the Wall Street market so you guys can actually see what the numbers were for yesterday. And here we go. There we go. So as you can see here, the Dow Jones down 500 points. NASDAQ Composite was down 366 points. And then, of course, you have the S&P down about 100 points there. Scrolling down, the advanced declines were 711 versus 2,470 on the NYSE. So generally, the market did not really care for this move by the Fed. But let's talk about this. Let's talk about what this might mean for the markets going forward. And first of all, I have to say I was surprised by the Fed, by what they did here with this rate. I didn't think they were going to do it. Okay. I thought they were going to kind of ease in, but I didn't think they were going to do the full 75 point rate. I wasn't exactly sure what they were going to do, but I felt that maybe a 50 basis point raise, I didn't think that was going to be out of the cards for Powell. So the fact that they went through with the deal and continued on with that 75 basis points, I have to say that was pretty surprising. They did come out and say that they're done. That now that they've done the 75 points, they don't, almost hinting that they don't have to be so aggressive with future hikes, basically hinting that smaller hikes could be in the future, which, I don't know. We'll cross that bridge when we get there. But for right now, that's basically what the Fed is saying. Let me go ahead and have a look here. Pull this up. So, you guys can see what I'm kind of talking about here. All right, so you see here they approved the rate, lifted interest rates by another 75 basis points. But here it is right here. I've highlighted it in yellow, possibly in smaller. Well, let me kind of go back. They signal plans to keep raising them, possibly in smaller increments, but to higher levels than previously anticipated. The increase approved Wednesday, the Fed's fourth consecutive 75-point rate hike or rate raise lifts the central bank's benchmark federal funds to a range between 3.75% and 4%. After the decision, Jerome Powell said the officials would contemplate a smaller hike in their next meeting in December, but he cautioned that they might raise borrowing costs next year more than have projected. And then he kind of goes on and talks a little bit about that. But I thought this was pretty interesting here, where Powell says it's very premature to be thinking about pausing. We think we still have a ways to go is pretty much what he said. And then, of course, you see there what the markets did and whatnot. Now, again, at their September policy meeting, most Fed officials projected that they would need to raise the benchmark rate to around 4.6% early next year. Officials didn't release new rate projections Wednesday. Mr. Powell said that if they had, they would have been higher given the recent strength in the labor market and the high inflation rating. A higher path for interest rates suggests a greater risk of a recession. Investors in interest rate futures market expect the Fed to raise the Fed funds rate slightly above 5% by next spring, and Mr. Powell's comments Wednesday suggested he likely agreed with that outlook. While Mr. Powell said he didn't think the Fed had raised interest rates too much, he repeated his view that it would be appropriate for the central bank to err on the side of overdoing it rather than underdoing it, because he saw a bigger cost for the economy and allowing inflation to become entrenched. Now, this is pretty interesting here what's going on, because what we're seeing here is a lot of back to the future, so to speak. Okay, we're seeing a lot of things that have reared their ugly head in the past, and they're starting to come to light. Right here it says officials are boosting interest rates at the fastest pace since the early 1980s to reduce inflation that is running near a 40-year high. They have raised they have raised rates by 75 basis points at 4 consecutive meetings. And again, the latest rate increase will bring the Fed funds rate to a level last seen in the first 3 weeks of 2008, as the economy was sliding into a deep recession. So yeah, they did it. But here's the thing. If the Fed is serious about getting inflation under control, then this is a step towards the right direction. Essentially, what they're going to do is, or what they're going to have to do, is really start having, to have an impact on inflation. They're going to have to get that Fed fund rate from, 3.25% to 5 at least. So today's hike, that takes it up to 3.75. We're just about at 4%, just about 4% now. So, they're going to have to take it up to 5% to really start having any sort of impact on inflation. Now, I want to break this down a little bit because, the whole point of this channel is not just talking about what's happened on Wall Street and the economy, but it's also about explaining some of the logic behind it. So I thought this would be a good video to talk exactly about, what does this mean? What does all this what do these rate increases actually mean? How do they work? And what's the real impact here? Now, these are just my opinions here. So if you have a different opinion and if you disagree, that's fine. I'm not here to prove anyone right or wrong. This is just my opinion on how I'm reading the situation. And for those of you who know me, you know that I was a portfolio manager with one of the largest banks in the world for some time. So I've been around these markets a little bit, enough to know, what some of this stuff means and how it operates. But let's talk about the Fed fund rate. Now the Fed fund rate, the way it works is the Federal Reserve, they print money and they loan that money to your local bank and they charge an interest rate. And that rate yesterday was 3.25%, but now that they raised the rates today or on Wednesday, should I say, this video may be coming out on tomorrow on Thursday. Well, Thursday today. So if you're watching this on Thursday, we are now somewhere between 3.5% and 4%. That's what they raised it to. So when Mr. Smith goes to the bank for a car loan or for a mortgage, the bank takes that rate and they add their own interest to it. And they put a little, something in there so that they have in their pockets, a little bit of money that they put in their pockets. So that 3.75 rate now gets boosted to about 5% or above, maybe 8%, maybe 10%, depending on the credit worthiness of the applicant. And that's how the local bank makes money. Okay, so they're working in conjunction with the Federal Reserve. So to get inflation under control, the key is that Fed fund rate. And why is that? Well, that's because the Fed needs to raise the rates to get inflation under control. This is because what happens is it stops the demand for money. Okay, it kind of dampens the demand for money. So if Mr. Smith has to pay more to borrow money to get his loan, well, he might think twice about it, now that he has to pay a little bit more interest. See, the price of money is interest. If the interest is 0, then basically money is free. If the interest is 5%, well, now you need to pay 5% on that loan. So the cost is 5. So if you want to slow down people borrowing money, then you need to do that by raising the rates. Okay. And what does that do? It slows down the money supply because now the money is being tightened. And when you do that, that's when you start to have more of an impact on inflation, and it starts to come down. So today's action shows me that the Fed is really going to try to get inflation under control, which is very interesting because the Fed is also to blame for creating the inflation in the first place by printing so much money and pumping it into the economy. That's what really kicked inflation into high gear, and a lot of people don't know about why they do that. It always makes me laugh when I hear people talk about inflation, and they get surprised when I tell them that inflation is created on purpose. They don't understand. But it's actually very simple. Now, after the crash in 2008, you guys remember the crash of 2008, you had a lot of people who lost a lot of money. And I'm not just talking about the middle class. I'm talking about the real high income class, the asset class, the wealthy that have much of their wealth tied up in assets. That class got destroyed in the last crash, and they needed a way to get their wealth back. And the way they benefited, the way they got back their wealth, was being benefited by inflation. Inflation helps the wealthy because now your home that was 2.5 mil is now worth 3.5 mil or 4 or 5 million. Your company is now valued at a higher price thanks to inflation. So if you own a company, it's worth more. Now inflation has its cons. Things cost more, of course, but if you're a millionaire, the cost of things don't impact you the way they impact you the lower you get down the pay scale. You can still eat, and if the burger costs 3 times, 4 times as much, that's fine because the values of your properties have also risen 3 or 4 times as much. It's kind of balanced itself out, so to speak. So the value of your portfolio goes up with inflation. The value of your business goes up with your inflation. The value of your assets, of your properties, they all go up because of inflation. But the poor guy down the street doesn't benefit from inflation because he owns no assets. But if you own assets, again, those assets have gone up, meaning your personal net worth has risen thanks to inflation. And people don't get that. But that's also because most people aren't in the asset class. This is an exclusive membership, and most Americans are not part of the club. So they don't get the inflation perks, so to speak. Now, what about the government? What about Congress? Does the government benefit from inflation? Absolutely, because it helps to pay down the debt to China. We owe China a lot of money, so we're paying them down with inflation. And how is that? Why is that? Because you get to pay China back with cheap dollars. Because when you have inflation, what does that do to the value of the dollar? The dollar becomes worth less than it was. So as the value of the dollar falls, so also it has an effect on our debt. We owe the same amount, but it's worth less than it was because the overall value of those dollars is worth less. So the rich benefit, and so also does the government benefit from inflation. So the need to stop inflation when you're benefiting from it isn't a real problem for these guys, which is why I mentioned how I said in the beginning of the video that I was surprised with the action the Fed took with the rate hike. I didn't think they were really going to try to deal with it. And I'm still not entirely convinced that they are going to try to deal with it. Oh, sure, they are going to talk tough and they're going to, they went through with a full 75-point hike. But I'm not so sure, when inflation keeps making the wealthy wealthier and also assist in paying China in cheaper dollars, well, I'm not so sure that they want to steer away from that path because suddenly they're concerned about the middle class and the guy down the street. And unlike most people involved in the markets, I was for this hike. Okay, most people in the market want lower rates, And I just explained to you why. That inflation, it benefits the markets and the assets go up. So as the assets go up, again, so does their net worth. So of course, Wall Street wants the Fed to do all they can to keep the market going higher. Us, on the other hand, those of you who watch my channel and you know how I invest, we could care less what direction the market goes because we've learned how to make money either way. When the market goes down, we short. When the market is rising, we're buying long. And since we're on the subject of inflation and on the markets, I want to pull up a chart for you guys real quick, because if you want to make money in the market, you're going to need to know what's happening here. And CNBC isn't going to tell you this. You're not going to learn this from them. So I wanted to pull up a chart here and kind of explain things a little bit. Let me see here. Let's go into the charts. Okay. All right, there we go. So this is the S&P right now, and you guys see this. You see this nasty downtrend that that we're having, that's going on. All these drops right here that you're seeing. Okay, you get a drop, you get a bounce, rises, and again you have another drop. Okay, so this downtrend here, this is large institutions, large hedge funds that are shorting, and they're selling the market. They're shorting here, they're shorting here, they're shorting here, and they're selling the market. They've been shorting the whole way down. You can see that right here in the pattern that's right in front of you. But along with shorting, you also get snapbacks, bounces, okay, where the prices rally up. Okay, here are the bounces. Okay, you get a bounce here. You see these bounces, and actually let me see if I could highlight it maybe. So you see here you get a bounce. Okay, you get a small little bounce, and then you get another bounce here. Okay, so you see these bounces that have been happening, snapbacks. Okay, and that's where the prices rally up. Now that's not Wall Street institutions buying. Okay, those bounces are not the institutions and the hedge funds going in there and buying stocks. That is the general public, or as I like to say, Main Street. Okay, the people that CNBC has convinced to buy the dip. You guys been hearing that buy the dip, right? That's the folks hearing buy the dip, hear it often and often, over and over and over again, and they go in there, and that's them going in there and buying the stock right on these dips. Okay, but it's also short covering. Okay, because if I'm a large institution and I've made 5 to 10% shorting the market, and I know people are going to start coming in and buying the dip, well, if I'm going to make my profit, I got to buy my stock back. So if I made millions from this right around here to here, so if I made a couple $1 million or whatnot, what I want to do is buy back my stock, the stock that I shorted, and when I do that, that buying is going to help push the market up a little bit. Okay, so all this right here, you're going to get short covering rallies where the institutions are covering their stock, they're buying back their stock, so they're pushing it up by buying it back, and also all of the people buying the dips are pushing it back. And all of these rallies that you've been seeing, that we've been having, it's all about covering those shorts after we have the big drops in the market. It's short covering, plain and simple. But if you don't get a break out of the downtrend, it continues over and over and over again. Okay, so you get stuck. So the market keeps going lower and lower and lower. And the reason we're not breaking out of this downtrend is because, unlike previous downtrends that we've had, if you go back to 2008, let me see here if I could actually kind of bring this back. Let me get that out of the way. Let me see if I could bring this back here. So you can see here, when we had this downtrend, right? We got out of it, and as the market was going lower and lower and lower, how long did it take to get out of this downtrend? So again, let me do this. And let's clone that. Let's bring it back. Okay. So we got out of this downtrend right around February. And how long did that take? Let's see if I can go in here. And adjust that. Let's see how long this actually took, okay, to get out. We broke that 200-day moving average. So it took about, let's call it here, about 125 days, okay? So we were in a downtrend for 125 days, 2018, to get out of that one. Now this one is pretty interesting here, okay? This was a pretty significant crash. We didn't really have much rallies, but we got out of this one very quickly as soon as we broke that 200-day moving average. Let's see here. It took us about 60 days to a little less than 60 days to get out of that downtrend, okay, the one that we had right here. And again, you can actually see it. And you can actually see that right there, okay? So about let's start it right there. Let's bring this back because actually it was less. Okay, so there we go. About 40 days to break out of that downtrend. Let me go back to this one just to kind of be a little bit more precise. Okay, let's see how long we took out of this one. So we have our downtrend there pretty much. And let's move that here. Yeah, okay. So about 120 days back in 2018. All right. And let's go ahead and go back to today. Okay. And let's see how long we've been in this downtrend. There's our 200-day since we broke. Okay, let's see here. All right, 284 days is how long we've been in our current downtrend. Okay, so if you look back again in I just kind of told you guys, I showed you what those downtrends look like and how long we quickly got out of them. Okay. We didn't last in those downtrends for nearly as long as we are in our current downtrend. Okay. It's been like 44 weeks and the market just can't break out of this downtrend. So here's the big question, guys. And let me go back here. So here's a big question on this downtrend. Okay. What happened here? Okay. Why is it taking so long to get out of this downtrend? We got out of it quickly back over here in 2020. Super quickly we got out of there. We got out of that downtrend. And then in 2018 we got out of it as well. It didn't take as long. Okay, but now you look here and what's going on? You're looking at 284 days. What's different now? Why could the market break out of those downtrends but it just can't do it now? And the answer to that is actually very easy, guys. It is the Fed. It is the money printing. Okay. Why could the market break out of those downtrends, whereas now it's struggling and it keeps moving lower and lower? It all goes back to what I opened with in the beginning of the video, talking about the Fed and the money printing. Those downtrends that we had, they were assisted, they were boosted, they were aided with QE, quantitative easing. The Fed was pretty much printing money and pumping it straight into the market to artificially move it higher. But guess what? We don't have that anymore. There's no more QE. And you're seeing the market struggling because it no longer has that money being pumped into the market. There's no more room for the Federal Reserve to print money and buy treasuries to bring those long-term rates down. They can't do that anymore. So I believe we're going to see the market go much lower. A lot of these stock valuations are really, they're just too high. They're still very high. When the market dropped 23%, the valuations really were high. They were still incredibly high, even though the market dropped, over 20%. To really get the valuations correct, you're going to need to see the market drop another 20% or maybe, a little bit more. These stocks are just way overvalued. So I don't see the market escaping out of that downtrend that I showed you. I don't see the market escaping out of that anytime soon. That doesn't mean we're not going to see rallies. Okay, we got election time that's coming up. And guys, what that means. Rallies. But do I think those rallies are going to stop the market from moving lower? Not at all. As a matter of fact, what you're going to start seeing here is rotation money moving out of growth stocks into value stocks as people start seeking shelter from the interest rate sensitive stocks like the famous FANG stocks. And they're going to be moving into old school value stocks, Caterpillar, Walmart, McDonald's. That's where you're going to see money starting to shift into as a lot of these tech companies just continue to fall. All right, guys, thanks for watching this episode of the Wall Street Money Report. If you enjoyed the content of this video, be sure to drop a like, subscribe, comment below, share this video with anyone you know who is involved in the financial markets. You can get in touch with me on my locals community. The link is below. And when you join as a donor on my locals, you get access to my private stock scan live streams, and you're able to ask me questions about investing, specific stocks, financial related topics. Locals is where I teach my community how to manage their investments and their portfolios. So be sure to follow my locals page if you're interested in learning more about investing. Until then, I will catch you guys on the next video.